Your Highness, thank you very much for your time. I'd like to start by asking, where did you first get this vision? Where did you first have this dream of Maidan and all it could be?
Everybody have a dream. Sometimes people, when they get up, they go back to sleep to complete their dream, or somebody get up and go and complete his dream by working. I wanted to be number one, not in the region, but in the world. I want my people to live better life now, to go to the high school now, to go to the good healthcare now, not after 20 years.
Dubai's property market has become one of the most talked about real estate stories of our time. Investors, celebrities, ultra-wealthy individuals, everyone from superstars to tech CEOs is pouring in, drawn by promises of zero tax, record-setting prices, and eye-watering rental yields. But beneath the glitz and glamour lies a dual reality. Is this a gold mine full of opportunity or a landmine ready to explode? Today we're doing a deep dive into the key metrics, the stakeholder motivations, and the hidden dangers shaping Dubai's future. To start, let's discuss capital appreciation. The idea that your investment grows as property values rise. In many global cities, real estate appreciates steadily, but Dubai's recent trajectory stands out. Over the last decade, average annual price growth in established markets like London hovers around 4%, New York around 6%, Mumbai and Delhi around 4 to 5%. But Dubai, we're seeing consistent 5 to 8% yearly gains, so much so that a prime downtown apartment bought for $1 million in 2015 could be worth $2 million today. That's a doubling in just a few years. And it happens without capital gains tax because Dubai doesn't levy it. Compare that to London's 20% capital gains tax, India's 20% tax on indexation benefits. You walk away with more profit in Dubai. Next, let's talk about rental yields. For most buy-to-let investors, it's about the steady cash flow. A $1 million property in London yields roughly $30,000 to $45,000 annually. New York offers $40,000 to $55,000. Bangalore and Mumbai are around $25,000 to $35,000. Dubai, you're looking at $50,000 to $85,000 per year, sometimes even higher. And with zero rental income tax, that becomes your actual cash flow. It's no wonder investors see this as a passive income gold mine. Why is this happening? On one level, it's no surprise. Dubai is positioning itself as a global economic magnet. Zero tax, ultra-luxury living, world-class infrastructure. Add its status as a tourist and business hub, high foreign investment inflows from Russia, Europe, India, Asia, and it seems almost purpose-built for real estate growth. But we have to ask, is the economic foundation sustainable? That leads us to our first warning sign, oversupply. Real estate crashes happen when developers build faster than demand grows. China's ghost cities are the textbook case. And the 2008 US crash showed how overbuilt markets implode. So, is Dubai heading into the same trap? We need to examine some fundamental indicators. First, population growth versus new residential units. A simple but powerful rule in real estate: if population growth outpaces unit supply, prices rise. If supply leads, prices collapse. Dubai's current residents per unit ratio stands at about 2.72. That's higher than New York's 2.55 and London's 2.3. Mumbai is even higher at 4.5 to 5, but that's partly due to massive undersupply. Dubai's ratio shows more people are moving in than new units are being built. That keeps prices rising sustainably, at least for now. Second, housing absorption rates. This measures how fast new developments are sold or rented. Dubai's overall absorption sits around 89%, with luxury properties even faster at 95%, often sold before completion. Compare that to New York at 82% and Mumbai at 83%. The high rate suggests strong demand, but if new supply continues to flood in, balancing those numbers could become difficult. Third, the price to income ratio. That's home price divided by median household income. Below 4 means affordable. Above 6 means only upper middle or high income earners can realistically buy. Above 10, that's luxury only. Dubai's PIR sits around 6.7, right on the border of affordability. New York sits at 14.6, London at 19.5, Mumbai 30 plus. So Dubai is pricey but not exorbitant compared to other global hubs. And for foreigners, affordability is less relevant. They're not earning local incomes. Capital ownership is what matters. Now let's talk mortgages versus rental yield. In most places, Mumbai, London, New York, the rental income doesn't fully cover a mortgage, so investors must inject cash regularly. But in Dubai, rent often exceeds the mortgage. That means after your down payment, your tenant's rent may pay the EMI and maybe even leave profit. That's a powerful driver for buy-to-let investors. So far, Dubai checks IPO-ready metrics: rising prices, high absorption, strong rental yields, and an affordability ceiling not yet burst. But the interwoven threads of this ecosystem can also unravel. First, global economic ties. Dubai's currency is pegged to the US dollar, and much of its investment climate is tied to global liquidity, primarily sourced from Western markets. When the US Federal Reserve raises rates or the US economy slows, global capital often retreats from risk-off environments. That was clear in 2008, when Dubai real estate dropped as much as 50% in value, not recovering until 4 years later. Today, the US is showing signs of high debt, slowing growth, rising interest rates. If a recession hits America, Dubai isn't insulated, it's likely to catch a cold. Next, foreign exchange and financial barriers. Many would-be investors in Dubai hail from countries like India, where the Foreign Exchange Management Act restricts home loan financing abroad. That means Indian buyers must pay full purchase value upfront or seek local UAE finance, locking up large sums of capital. That reduces flexibility. Plus, while Dubai doesn't impose property or capital gains tax, your home country may. Indian buyers still owe income tax on Dubai rent and capital gains tax when selling. If they don't declare them properly, they may face penalties or unwelcome tax audits. We also have to consider over-regulation or market corrections. The Dubai government has in recent years instituted steps to limit overbuilding, higher bonds for developers, tighter mortgage limits, increased bank scrutiny. That's encouraging but not a guarantee. Economic shocks could still stall developments, leaving buyers in limbo. A suddenly halted project can erode confidence and slow down resale liquidity. But there is more beneath the surface, an investor's targeted approach. Dubai's market is not uniform. You have 5 main segments: ultra luxury, $2 million and above. Think Palm Jumeirah, Emirates Hills, downtown. These properties often appreciate 100% plus over time, but rental yields are low, around 5 to 7%. Buyers are wealthy enough to buy prestige, not cash flow. So for the everyday investor, it's less interesting. High-end luxury, $800,000 to $2.7 million. A step down in cost, but still premium. Yields reach 6 to 8%. These are high-income investor-friendly, good for both appreciation and decent cash flow. Mid-range, $300,000 to $800,000, arguably the sweet spot. These units, found in Jumeirah Village, Dubai Hills, Town Square, Creek Harbour, combine strong appreciation potential with solid rental income. Many local investors recommend this as the safest balance. Affordable housing below $270,000 includes areas like International City, Dubai South. These offer surprisingly high rental yields, 8 to 9%. They're accessible, entry-level, and frequently rented by young professionals and families. Capital appreciation is slower compared to luxury, but income is steady. Worker and low-income housing, Jebel Ali, Al Usan, and Periphery. These units generate over 10% rental yield, often the highest cash returns in Dubai. But they come with real operational headaches, low margin tenancies, tenant turnover, maintenance issues, and capital gains are usually lower. These are not for passive or passive plus investors. They require active management. Your strategy needs to align with your goal. If capital gains excite you most, high-end to ultra-luxury suites. If income matters more, affordable or worker housing delivers. If a blend of both is your goal, mid-range is ideal. The key is matching the investment segment to your risk-return strategy and your management capacity. But let's not sugarcoat it. Dubai has pitfalls. Economic dependence on US, a downturn there, or tighter monetary policy could trigger capital flow reversal. Regulatory changes, mortgage limits, bonds, developer capitalization requirements change. More regulation usually helps, but sudden changes can disrupt market sentiment. Country tax liabilities, Dubai's zero tax only covers local jurisdiction. If you're Indian, British, American, you still owe your home country's tax. Not declaring rental income or capital gains could land you in hot water. Oversupply risk. Dubai is known for rapid development. One wrong calculation from developers, even in one district, could tip supply-demand balance. A sudden wave of unsold units could drag down prices across the board. Financing barrier. Many foreign investors must pay cash. That ties up capital and limits diversification. It's harder to buy multiple units across different locations or asset types. Then there's the psychological aspect, fear of missing out. When prices keep rising and headlines talk about crores in profit, it's easy to jump in. But every cycle contains a peak, and the moment it's identified is usually when fundamentals have weakened. Speculative buying based on sentiment can backfire. So, where do we stand? Dubai is presenting a golden opportunity. It has no local tax, strong population growth, impressive rental yields, diversified market segments, and a global investor narrative. But to call it bulletproof would be wrong. Everything depends on timing the global economic cycle, avoiding overpriced segments, picking the right price point relative to your strategy, managing tax liabilities back home, and staying alert to global headwinds. If you're drawn by growth, mid-range and high-end properties in growth corridors are best. If you value cash flow, affordable or even worker housing can deliver double-digit yield, but expect operational demands. If you're flush with capital and want prestige and tax-free capital growth, ultra luxury can work, but you pay for exclusivity and tolerate low income returns. Before you act, make sure you map your investment goal: appreciation, income, or both. Understand your financing: cash upfront, local loans, or foreign exchange limits. Calculate your total return: rental minus EMI plus capital appreciation. Understand your tax obligations back home: rental income tax, capital gains tax, reporting rules. Evaluate market timing, track global monetary policy, US Fed decisions, global investor risk appetite. Choose location carefully: absorption rates, new supply pipeline, infrastructure plans. Plan for downturns. How many months of vacancy or price correction can your finances handle? Dubai's real estate market is neither a magic bullet nor a guaranteed failure. It's an opportunity that demands strategy, discipline, and awareness. Approach it like any other asset class, with rigorous due diligence, position sizing, risk sizing, and exit planning. To conclude, Dubai can absolutely be a gold mine if you go in eyes open, but it can become a landmine if you buy glam grade without fundamentals, ignore tax and FX risk, or bet against economic cycles. Ultimately, if you're investing 1 crore or $1 million into Dubai, make it with intention. Choose the right price segment, right location, right financing, and right tax structure. If you do that, Dubai could be a powerful global real estate opportunity. But if you do it blindly, driven by headlines or hype, it may be a gamble you can't afford. That's the real story behind Dubai's booming real estate. Incredible upside if managed carefully, and painful downside if approached without rigor.